All right, our fourth category of ratios are called efficiency ratios. How efficient are we using our assets, the things that we own? The first efficiency ratio is called inventory days, if we have inventory. Inventory days is our average inventory, or most companies use what's called closing inventory, whatever's on our balance sheet. Inventory divided by annual cost of sales divided by 360. 360 in this case is considered the number of days in the year. So cost of sales divided by 360 is average daily cost of sales. So inventory is 40,000. Average cost of sales is 972. We get inventory days equals 41.14 days. We're calculating days here. So what is that number telling us? It's telling us that we're turning our inventory, we're flipping our inventory on average every 41 days. Again, this is assuming we have inventory. We're turning our inventory every 41 days. In this case, the lower the number, the better. Because if we're turning our inventory in fewer days, that means we're freeing up our cash faster. Less inventory translates into more cash. So the lower the number, the better. So how would we judge this number? Well, if I was let's see, what would be an example? A car dealership, this would be a great number because car dealerships turn their inventory maybe once or twice a year. A jewelry store, they turn their inventory maybe once or twice a year. So 41 days would be outstanding. If I was Walmart, this would be a terrible number because Walmart or your typical grocery store, they turn their inventory like once every week. Their whole business is based on speed of turning inventory. So if I was a grocery store, that 41 days would be very slow. So again, it depends on your industry, whether this is a good number or not. The next efficiency ratio is called days sales outstanding. Some people call this days receivable. Same thing. We calculate days sales outstanding by taking our accounts receivable divided by our annual revenue divided by 360. We call that average daily revenue. So in this case, we get 75,000 receivables divided by average daily revenue, 2,083, and we get days sales outstanding of 36 days. This is telling us on average, how fast are we collecting our receivables? How fast are we collecting the money that is owed to us by our customers? And in this case, we're collecting our receivables about every 36 days. Now, is that a good number? How would I tell if that's a good number? Well, the best number to judge that by is our credit terms. So if I'm allowing my customers to pay me, if my credit terms are 30 days, if I tell my customers, you need to pay me every 30 days, 36 would be okay. Because I always have one or two customers that may be delinquent, that may pay late. So if my terms are 30 days, 36 is not such a bad number. If my terms are 30 days and my day sales outstanding calculated to be, 50, I would be very concerned because now they're taking an extra 20 days to pay my bills. That seems like way too much time. So again, I would compare my day sales outstanding to my credit terms to determine whether it's a good number or not. The next number is called days payable outstanding. Now we're looking, how fast are we paying our vendors? So we're going to take our accounts payable right off the balance sheet, $50,000, divided by our annual daily cost of sales, which is 972, and we get days payable of 51.44 days. So this tells me that I'm paying my vendors on average every 51 days. Is that a good number? So again, I would compare that to what are my vendors' terms. If Margarita is one of my vendors and she has told me, Tim, you got to pay your bills every 30 days, and I'm paying them in 51 days, I'm using an extra 21 days. Margarita would not be very happy about that because I'm paying late. I'm using too much time to pay my bills. So again, we would compare this number, this days payable outstanding, to whatever our terms are from our vendors, 30 days, 45 days, 60 days. Our fourth number is called total asset turnover. And we calculate total asset turnover by taking revenue from the income statement, in this case, $750,000, divided by our average total assets, 410. In this case, we get total asset turnover of 1.83. This tells us as a whole, how fast or how efficient are we managing all of our assets on the balance sheet. And so one way to look at this average total asset turnover is it's telling me that for every dollar in assets, I'm generating $1.83 in revenue. How productive are my assets? For every dollar in asset, I'm generating $1.83 in revenue. The higher the number, the better. Okay.